let's say that somebody lived in their property for 2 years and then they rent out the property for another 3 years, or let's say they rent it out for to the point that, let's say that they rent it out for the next 10 years. What happened? Is that now classified as an investment property, or is that still part of the you lived in the property for 2 out of the last 5 years?
No. So in that situation where you had a property that you lived in for 2 years and now you've turned it into a rental, once you pass that 2 of the 5 year test, so basically it's a 5-year window that the IRS looks at. You've got 2 years you've lived in it on your own. You've got 3 years as a rental property to still have this gain exclusion. So if you hold this rental property for 10 years, you're not going to be able to exclude any of the gain on that property. It would be when you sold it, you would be paying tax on that. No exclusions, no nothing. On 100% of the gain, you'd be paying taxes on.
So let me ask you this question. So let's say that it's you lived in the property for 2 out of the 5 years, and then let's say you rented it out for 4 years. No, not. Let's say you lived in the property for 1 out of the last 5 years. Let's say you lived in the property for 1 year, and then the next 4 years you rented out. You lived in the property. Sorry, it's getting confusing, but
yeah,
I think hopefully you get what I'm trying to say. Let's say that you lived in the property for 10 years, and then in the 5-year window you rent it out for the next 4 years. So it's essentially, how is that looked at? Do you know what I'm trying to say? Or
yeah, I am. It's kind of, once you move out of that house, the clock starts ticking. And so it doesn't, as long as you've lived there 2 years before that date, you're good. And then the clock starts ticking the day you move out. If at that point in time, once you move out and turn it into a rental property, you have basically 3 years to sell that house and to still take advantage of the gain exclusion. So if you're renting this property for 4 years, you're outside of that window and you're going to pay taxes on the gain. So the kind of the goal of this, if you're trying to exclude as much gain as possible, is to, yes, move out of the house, and then you want to rent that house for 2 years and 364 days. And on that 365th day, you sell it, and then you'll still be able to take advantage of this exclusion.
Is there any proration on that? Like, let's say somebody's like, oh my God, I lived in this property for 10 years and now I've had it as a rental for 4 years. Technically, 1 out of the last 5 years, I still lived there, but essentially I should have sold it before the 3 years. Is there any proration for that 1 out of the last 5 years? Or is it just, if you don't sell within that 3-year mark of turning it into a rental, it's classified as an investment property. Now you have to pay full capital gains.
Right. Yeah. If you miss that 3-year window, now you've turned it into an investment property, because if you're looking at that rental for 4 years, you haven't lived in it the last 2 of the 5 years. And so you would fail those tests. So yeah.
And there's no proration on that. There's no like proration, like 1 out of the last 5 or anything like that.
No, nothing like that. So that's a risk, is if you turn your primary residence into a rental with a goal of selling, you don't know what the market's going to be like 3 years down the road. And you might not be able to sell it at that point in time. Or maybe you have great tenants and this is a great cash flow and it turns into a great rental property for you. But it's something to consider if you're doing this, is that 3-year deadline is a hard deadline.
And this is what I tell my clients, because it's something to take into consideration, because sometimes people do it as a backup option, or they do it on an emotional basis because maybe they didn't get the right price for their property. You have to take a look at what is the marketplace going to be doing over the next 3 years, because that exclusion is big. I mean, you can exclude up to $500,000 for a married couple, but let me give the consumers a quick scenario. So let's say that you rented out the property, or you moved out of the property in 2012, and that 3-year window expires in 2015. Great decision. The marketplace appreciated. You are able to capitalize on some of the appreciation and still get the exclusion, as long as you don't go over that 3-year mark. Let's say you make the same decision back in 2008 or 2007, and it gets to the point where you can't sell it at the price that you wanted to anymore. Now you're forced to hold it on for longer than 3 years. Now, essentially, if you sell it, now the market has depreciated or gone down tremendously. So essentially, when you think about, do I sell my property, or do I sell my primary residence, or do I keep it? a lot of it depends on what are you thinking that the marketplace is going to do, and what does the data show that the marketplace is going to do? Because 2012 and 2008 are completely different scenarios. One of them is a great decision. The other one's a horrible decision, essentially.
Right.
Yeah. So good.